Hey, welcome to the Airmere Trading Group 1 meeting. Today is the 29th of March, 2021. So welcome everyone. Nice to have you here. Hey Wayne, I was looking at the sleep well, and I guess IWM's having a fairly big move. It's down about almost 3.5% this week. I'm guessing it might have something to do with that Suez Canal ship that's stuck. Do you have any thoughts or?
Oh, well, I mean, I've got tons of thoughts and everything. I mean, really, I would probably say it has a little bit more of other things. I mean, small caps have been ran up for a long time. Their expected return going forward is probably starting to, reach an equilibrium with large caps, and so a general rotation is probably more of what's going on, what's just generally expected. Um, and I mean, goods are getting more expensive, so that's probably going to hurt, short-term purchasing in small caps. We're at the end of stimulus or so far, we'll see kind of what's going on. So, I mean, there's some risks and there's some unknowns going on, but it looks like generally there's just a rotation. Small caps have benefited really well from a lot of the stimulus, and it looks like, I mean, if I was playing this in like a non-macro sense and I was trying to do like a pairs play, which isn't what the sleep well portfolio does, right? There's plenty of strategies out there that do pairs, but the Russell's definitely been pretty hot for quite a while. And I've had a few people actually, I had a few people reach out to me a few months ago, actually probably just like a couple months after the sleep well was going. And investor behavior is really, really common across a lot of threads. And it was, there was some people that were a little bit hesitant to get into the sleep well because of small caps being on a power push for a long time, even at that point, right? And then they kept going, right? And they kept pushing up and they kept kind of doing their thing. And then all of a sudden, 15% over large caps now later, um, finally that hesitancy actually proves right? Now we're getting pulled back, but we're still, 15% over large caps. So it's kind of like, well, what do you do now, right? And unfortunately, the investor behavior is typically now something is having a hard time to not do something because now it's having a hard time, right? So it's kind of like you're damned if you do, you're damned if you don't. And so there's kind of this ever behavioral play that's going on too. But as far as the assets go, I'd say it's just a general rotation. In general, small caps and large caps will still kind of continue doing their thing. Um, so we'll kind of see what ends up happening, but I don't know if the Suez Canal, or I don't even know how you could pronounce it. I'm sorry,
The
but
Suez?
Suez, yeah. So the canal will definitely affect some commodity prices and stuff like that, which will keep actually pressure up. So you might see oil stabilize instead of like continuing back down to its back down to an equilibrium, and that might be a little bit of boom for energy, although in this macro environment, from the things that I follow, energy is one of the worst performers in this macro environment that we just shifted into. So, and same with materials. So those two aren't going to have a really happy time, most likely. I mean, I say that, but it's all probability, right? I'd be more focused on kind of what the currency situation is, and I can get into that if you want. But
Oh,
please go
yeah,
ahead.
that
Oh,
was interesting. Let's see, there's something in the chat. This is, but Wayne, if you look back at previous declines, most of the time the transition from rotation to liquidation was almost always the case, or was. Yeah.
rotation to liquidation. Yeah, I mean, sure. I'm not quite understanding what you're asking there. But if you can elaborate a little bit more on that, I could talk about it. Because yeah, what kind of liquidation? Are you talking about liquidation into cash or things like that? There has been more demand on cash. Um, that's why, like, if you're following the sleep well portfolio, we use UUP for our dollar relative deflationary product. And there's been some pretty large moves in that situation. Is it transitory or not? There was something quite interesting that probably didn't make it to the news very well, but the Federal Reserve actually brought back the requirements for banks for their cash reserves that they loosened up during COVID. That's a really big move. That's a tightening move. And stocks are behaving accordingly to that, but also so is the dollar, right? So these banks need to build back up their reserve requirements, and so their demand on dollars will start to have an effect on the currency. So those types of things. So that's why we're probably getting a decent rise in the U.S. dollar for now, but also that plays off of what other currencies are doing. Here I can. Do you have? Do I have screen sharing availability?
Oh yeah, sorry about that. Now you
Okay.
do.
Let's see. I can just kind of throw this up. This is something I look at. You should be over on this left screen, right?
Yeah, I see inflation forecast.
Perfect. Here I can full screen this, so it's not like a tiny little thing here. So anyways, this is something that I always kind of pay attention to, because it's really this is OECD data, and so blue back here is actually the US dollar. Purple is like their total, and then red is kind of the Eurozone. And the Eurozone the Euro pretty much has a pretty strong effect on how the dollar plays off of things, but you can look at this ODEC too, or OECD. But anyway, so right now we are early 2021 right here. And so what we kind of want to pay attention to is like what's going on with the dollar and how that's going to affect stocks and how that's going to affect other things. Is a strengthening dollar isn't necessarily a bearish thing for stocks, but a strengthening dollar can be bearish for bonds in the short term, and then as it equalizes, or if the Fed does something about it, it can actually be a really bullish thing for bonds, which bonds inherently affect stocks. So the gap between Eurozone and the US, if that starts to close, right, regardless of the total direction of inflation, right, if this gap begins to close, we'll see a strengthening in the dollar most of the time. And we're coming into 2021, and you can see here, even though there's this rise in inflation in the first quarter of 2021, which we've just finished, there was a close in the gap, right? So this gap down here was bigger than this, which was bigger than this. So which is why we've seen the dollar starting to gain in value. And then you can see the gap even closes tighter. And then something to note there is that we even get a deflationary push on the US dollar on its own, which is, bank requirements, whatever actually happens because of it, that's a totally different story. But these projections are actually normally pretty nice just to know kind of what general trends are. And then late into 2021, inflation will continue to pick up. And then it looks like the Eurozone will kind of fall off a little bit, and they'll go through a little small deflationary cycle. But then looks like the end of 2022, everything's going to be pretty much climbing at a pretty strong inflation rate. And if that happens, probably once we get into like mid 2021, we'll probably start to have some pretty good, strong pushes in gold to the upside as inflation just kind of kicks up in general across the board. But for now, this general push down from the highs up here all the way down would be really bullish on gold. But then now, once we're starting to push up, right, since probably first quarter of 2020, we've been having some hard times with gold. And that's pretty common. But anyways, so those types of things, if we get like a combination of, like gold rising, the US dollar rising, that's going to put some serious headwinds on stocks in general. But as far as this, like, rut to SPX, most likely transitory, but I mean, it's definitely not uncommon for Russell to have some headwinds lately after just having such a large rise and us benefiting from it for so long.
Oh, and he says even the always bullish Dalio seems a bit scared at the current levels and all the big funds are selling.
Oh, so he's just talking about like general liquidations. You know what's always interesting is I swear they release these or they ask like certain questions to these big fund guys like specifically during corrections. And so like yeah, there's probably definitely some bearishness. Like I mean even from what I look at, like there are definitely some serious headwinds, you know, later this year, early next year, or something like that. But that doesn't mean that we can't go up another 30% before that. And I know that might sound crazy, you know, but um, you know, we'll kind of see what's going on. The reopening of the economy, those types of things, there's been serious consumer demand. Um, you know, I don't know if anyone's like gone to a local mall lately, but they're like madhouses right now. So we'll see if we just kind of bounce back to usual. I mean, there's been a lot of demand for Chinese products in the pandemic, and a lot of people got paid a lot more than what they were making at their regular jobs during the pandemic on unemployment. Um, so, you know, we might have been able to stave this off. The problem the real problem is actually going to be the bond market. I think at least this is just kind of the things that I look at, is the bond market that ends up eventually, um, you know, if we're going to have to monetize more just to keep up with the demand of the debt of the government. So, and then, you know, Biden's talking about taxes and you know, no matter how you look at it, right? So the Federal Reserve tightened bank bank requirements, so that decreased the leverage in the economy. That's a tightening. Then we've got the 20-year bond and the 10-year going up and starting to equalize with stocks or getting close to them, right? That's tightening. Then on top of that, we've got a president hell-bent on taxing businesses and the wealthy, quote unquote. Um, and that's tightening. Now, historically, anytime a country attempts to, uh, especially in this global time, I would say, anytime a country starts to attempt to tax the wealthy or tax, you know, quote unquote, the wealthy and tax businesses, they just move, right? That's why we had so many tax inversions back in the Obama era and things like that. So, um, you know, America's a strong player, the US is a strong player, but that's kind of where I would concern is that all these tightening effects, right, to pay off everything that happened in the pandemic is eventually going to tighten an issue, and then the debt's going to rise because they're probably not going to be able to collect the revenues, like what Janet Yellen said, the revenue increases, which is basically increasing in taxes. So where are they going to get the money to pay off this debt? It'll be really interesting, kind of how everything plays off. But if the Fed has to monetize more to take care of the demand that the government has by selling bonds because there's no demand out there from other countries, um, that's a really scary situation because then we could have rising inflation, which in that case we most likely would, and then on top of that, um, now we can't raise interest rates to fight that inflation because the government can't handle those interest rates, and we're having to monetize. The Fed's having to monetize to pay off that debt, or to give the government money because its revenues aren't there. So it's kind of like in this trapped spot. So they're really playing with some fire here, and there's some really smart people, so they could probably pull it off. So I definitely wouldn't bet against them, but it's definitely something to keep an eye on because that's going to be a major headwind in the U.S. economy at some point in the future, but it's not right now. I feel like we went on a rant.
Yeah. Vic says the alternative to increasing taxes is getting to get people back working. That's true.
Yeah, just raise GDP. That's a heck of a lot. Yeah, it's kind of like a business. I mean, when we look at the economy as a business, which in essence it is, it's like, well, you can do one of two things, right? You can either cut costs, right? And typically a business that really focuses on cutting costs eventually dies, right? Because their product gets worse. They're just so focused on contractionary measures that eventually they kill off their growth and they stop focusing on their growth. Or you can sit there and say, hey, let's just increase revenue and increase sales and just be mindful of our costs, but give a quality product. Um, yeah, that's one of those measurements of a business that if you ever look at a business and they sit there and say, yeah, we're focusing on decreasing costs and things like that, like run away. They are not expansionary. They are not growing. They might be increasing their profits, but they're not growing anymore.
And Vic says usually increasing taxes produces less tax revenue.
You're right,
Yep.
because they run away. Like, I'm like, I'm sitting here looking at like, okay, Biden's increasing some taxes or they're planning on it or something like that. So my first thought is like, okay, well, what would it take to like go to Singapore or something? I mean, the rich are way more mobile than I am. That's exactly where they're gonna go.
Oh,
So,
yeah, I mean that's why people go to like Puerto Rico because, oh hey, no federal income tax.
right, right. And the US has been the dollar, has been the reserve for so long that we've had this benefit of like, basically printing free money, free GDP almost. And you know, um, if that falters, which like China, like here actually, I was doing research, and this is kind of just what ends up happening, right? Let's see, I had it up here. No, oh, there it is. Yeah. I mean, this is probably an old topic right here, but I mean, China's a powerhouse now. You know, um, they're not the freest people on earth for sure, but there are some other areas that can significantly compete with the United States now. So, you start bringing up some serious taxation, and it's going to be some issues. But Tom, to kind of bring you into this fold. I mean, you lived in Europe for a long time, and you're significantly more globalized than I am. And there's really, really high taxes over there. How do you feel about those types of things?
Well, yeah, I mean, like you don't see a lot of RVs in Europe. People don't seem to have as much disposable income as they do here. You know, just the sales tax rate of the VAT was 19% in Germany, 21% in Belgium, or no, yeah, 20, yeah, 21% in Belgium, and then like about the same in Portugal. Gas was the tax on fuel is about what we pay for fuel here. So the fuel, like to gas up your car was like, $100, and here it's like 40 or 50. Um, so people tend to buy, cars that are much more efficient there because it's so expensive for fuel. When Gabby was working as a young 20-something-year-old, when she left her parents' house, she had a full-time job, but she could barely afford a telephone because the income tax was so high. It's anything over was it 45,000 euros in Belgium is like a 45 or 50% tax just on the income tax, and then you have all the same kinds of taxes we have here, like Social Security, they have a solidarity tax, blah blah blah, and the maximum tax I think was somewhere around 80%.
Hmm.
So you have your 80% tax, and then on the 20% you have left, you got to pay 21% sales tax on top of that of anything you buy with it.
How is it? So that's like the civilian tax and everything like that. How's the business taxes over there?
I don't know. I didn't have a business over there. I had a U.S. company, so
Hmm.
I'm assuming it's. I know it's a lot harder to start a business. Like in Belgium, you had to open up a bank account and put like 13,000 euros in it to start a BVBA, I think it was, which is
Hmm.
like a corporation. And tons of paperwork and you know lots of government forms to fill out. Like Gabby said, the tax forms are like a big stack of paper you have to fill out every year. So it's extremely complicated. even things like customs. We would ship something to Germany from the US, and then the customs people would get it and they would say, oh, well, you paid X dollars for the product and Y dollars for the shipping. Let's add them together and apply an import tax. And
Mm.
then the sales tax people would say, oh, well, you just got something that was worth um, the product cost, the shipping cost, plus the VAT, add them all up, and now or the import tax. Now let's add those all up and apply a 20% or 19% sales tax on all of it. So they're taxing their own tax.
Yeah, and I mean, and that's just a very typical historical, pressure that happens is in general, the people demand more out of their government. The government appeases the people, right? And at least in democracy, right? And well, since they want to appease the people and they want to be, reelected, whatnot, and so forth, you can say it's corrupt or whatever. But I mean, they're trying to sit there and appease the people. So what do? They enact laws that do that, but then they have to collect the revenue to pay for that, right? And in a um, in a capitalist country, it just doesn't work that well because the supply and demand, as soon as you pump a bunch of money into a certain product, right? Now you tweak the supply and demand because the demand got significantly raised because you can, uh, because you can charge more for it because there's more money to be paid for it. The same thing happened with colleges here, right? I mean, we still have some of the best universities in the world, and there's a lot of Western educated people in the world, and luckily in the Asia specifically, a lot of them went to our universities. But yeah, there's this kind of ebb and flow of like, okay, here you want to appease the people, you want to help the people, but at the same time, we've got to live in this capitalist country. Where do you come? And our government is benevolent in general, right? And so, or at least I'd like to think so. And if they're trying to help, how can they help? What kind of tools do we give the government? Well, the government can either restrict businesses, kind of like what they did with airlines back in the day where they regulated airlines, right? But if they let supply and demand kind of free float and let everything's kind of go where they do, the best thing that they can do is pump money and subsidize into things, which short term helps out, but then long term it just annihilates it because it gets more expensive. Which I think is kind of exactly what you were talking about, Tom. In Europe, is as a civilization grows, right, we get um, all these built up requirements and demands of the people over time that the governments have been attempting to help out, and their costs have been going higher, and they're typically really bad about spending money. So it just increases expenses for things in general, which then makes them now draw more taxes, and round it goes. And then the businesses and the wealthy just leave when it gets too expensive there, and they'll just sell things to them, but they won't be there anymore. And then now you really lost your tax revenue.
Yeah, like I know France has a wealth tax on the super wealthy. It's like 1 or 2% of your net worth if it's over like 10 million euros.
mm,
So that makes the high net worth people move somewhere else. So they go to like they have how like Oprah has houses in Colorado, California, Hawaii. She just goes where she wants to, and the same thing with the high net worth folks in France. If they're going to be taxed like that, they leave. And there's some comments in the about like Europe, like healthcare. It is essentially free. I remember we went to the doctor one time and they're like, oh, what's your health insurance? They go, well, we're not European. We don't have any. He's like, oh, you got to pay the whole thing. And it was like $20. Um, and then university also extremely inexpensive. My two youngest kids went to school in Kaiserslautern in Germany, and I think the tuition was about 216 euros a semester, which is like less than $250.
oh, that's gravy. I would have loved that.
Well, in fact, Brennan had one of his classmates was from California. His dad didn't
Mhm.
want to pay U.S. College tuition rates, so he sent his kid to Germany. Now he did spend a year in Köln in his senior year of high school, like an exchange student, to learn German. But yeah, school is extremely cheap. But then part of that also produces way too many of certain things. Like in Belgium, for instance, there are a lot of people with PhDs or doctors, and there's kind of an oversupply of highly educated people, at least for medical. There's doctors on every block practically. So, okay, education's free, but then you get a lot of people with degrees that can't find work.
Yeah, I mean, everything is like behavior is so adaptive, right? I mean, to bring something probably very outside of this realm into this, but I used to play MLG, and we would construct plays for certain maps when we were competing against other teams, and certain plays would work for a little while, but then all of a sudden, boom, the other team would adapt and would just completely do something totally different, and that play would just completely break down. Kind of similar to trading, right? Trading works for a little while in certain areas, and then enough people pile into it, and then all of a sudden it stops working, or the edge starts to go away, and you got to find something else. Those are trades, right? And not investing, right? Totally different animal. Um, and so um, I mean, behavior is fleeting in a sense that, you start taxing people differently, and, we're going to find different ways to get away from it, right? And the people that definitely have a lot of money already can afford some really, really good ways to evade it, right? Or they'll just leave, right? They just don't have to have their residency here. They probably have residency in a lot of different areas. Um, like I said, I was even looking at Singapore and stuff like that. Not saying that I would or anything like that. I'm a long way away from that, but it's just
Now,
one of those things.
now, one thing, if you're an American citizen, even if you move to Singapore, you still have to pay tax on all your worldwide income. So that's
Yeah,
why, like the co-founder of Facebook gave up his U.S. citizenship and moved, I think it was just to Singapore, right before they went IPO, because he was an instant billionaire. But now, because he's not a U.S. citizen, he doesn't have to pay the tax on it. And there's big outrage about it. But that's what the wealthy do.
yeah. I mean, you're gonna find a way to get away from it, right? Offshores, things like that. I mean, it's amazing. And so, yeah, unfortunately, this whole, tax the wealthy type of thing, really what ends up happening is, the government still has to make their revenue. They've still got to take care of their constituents because they've been demanding, well, we've been running this debt to the moon, and we're even possibly getting to a point where there's not demand for American debt, or there's not enough demand for American debt for the amount that we're attempting to sell in bonds. And if that actually happens, right, because bond yields are too low for the demand, then we really go into like kind of like the Greek austerity issue. But unlike Greece, which had to deal with the Euro Union, we have the Fed. So then the Fed would end up monetizing it. So, um, but then at the same time, how long can that go without just inflating like crazy and debasing the US dollar, and then maybe we'll have to sell some assets instead of bonds in order to make up for it. So that would just be a really interesting situation. And that's probably on the horizon unless, some pretty big things change, but it's possible. Um,
I know there was another comment about the unemployment in France, how the France tolerates high structural unemployment because it's tough to hire and then lay off workers on an as-needed basis. And Gabby said when she was working in Belgium, she had to give her employer a 1-year notice when she was leaving.
oh,
Um,
wow.
you can't just quit. It's not like here where hire at will, fire at will. It's you have to give the workers a chance to find other employment. So I think blue collar workers were something like a 3-month notice, but white collar was a year.
Mm,
And most people have employment contracts. For here, it's just like, hey, you're a good fit. And you want to start Monday, and it's a totally different relationship with the employer and employee. it's I don't know, it's kind of a double-edged sword, of course. You can have a job today and then get a phone call and you're not working tomorrow. But
Right.
that doesn't happen in Europe. But there's pros and cons for it, I guess.
Yeah, I mean, a little bit of that slow hiring and firing probably creates a little bit of entitlement, right? So, you might just get like a little bit less of an aggressive workforce. I mean, like, there's so many statistics about Americans and, the fact that, like, I think it's like 80% of them don't take all their vacation every year and things like that. I mean, it's just, you know, the there's a lot of sickness here too, so I'm definitely not even going to go into that. But I saw this comment about, who will the institutions uh, buy, as far as the debt, China. I mean, you go where it makes more sense, right? I don't necessarily know if it's China, although what'll be a really interesting situation is if we end up debasing the U.S. currency enough, which right now, I just want to point out that the U.S. currency is actually poised to strengthen. Let me point that out again. So you'll hear a lot of doomsday out there right now, especially right now, right? Because it's probably opposite of trend. Like, we have against the euro and against other major currencies, we are actually strengthening right now. And all the metrics that I look at say that we'll probably continue that strengthening for at least a little while. It might not be that long, right? It might only be like, a couple more months or something like that, before we start really inflating again. Um, but definitely watch out for that. But if we do really debase the U.S. currency enough, um, and we shrink our economy at the same time, that would be a really interesting play, because that's where this starts showing up is if China actually overtakes the number one economy in GDP nominal sense, right? I don't have a graph of the nominal one. I mean, I'm sure Google would find it really quick, but that would actually really be a contradiction to world history, with the major reserve currency not being the number one economy in the world. Um, so that'll be kind of interesting. And as China continues to grow and they grow their world trading partners, that's where things get really kind of interesting. Because the U.S., like, yes, we can only take this U.S. little slice down here, and this is probably a pretty old graph right now. But if you actually were to like take all and were to color all of the U.S. trading partners, it would be, almost probably 80% of this graph. And then if you were to compare that and maybe do like a Venn diagram, right, of all of the Chinese trading partners, it's significantly less. Or with so, but it's growing. I mean, they're nipping at the United States heels. So yeah, whose bonds would they buy? It's possible they would buy some China bonds. They're definitely yielding better than us. So um yeah, I mean, there's a lot of good things out there in the world. And as a citizen of the United States, um will all of this end up blowing up in our faces or something? I mean, maybe a generation from now it'll be significantly different. I think by projections right now, China will overtake the United States as the number one economy if they continue growing at their rate. They'll overtake it by like 2026 or 2028 is that kind of area. So we're not far off from that actually happening. So 5 to 7 years or so, and that's when will we lose the world reserve currency? Well, on a positive note, we just printed a boatload and got a lot of stimulation. If we were going to lose the reserve currency, at least we kind of went out with a bang and we, sucked it for all it was worth. And then now if we end up going to something global or something like that, that would be definitely different. Yes, it's gross, not per capita. Yeah. Per capita is a totally different issue because, China has so much population, which that actually brings up a great thing, Mark. You're right. And I mean, Tom, if if you had a country to take care of, right, and things went fully automated, so basically you don't need your population to actually work. Say it's all robotic, digital, automated AI, right? Which is, some would argue, is the future of economies. If it was like that, would the country that has the biggest population burden have more of a headwind in that type of situation because they're going to have to take care of their people? Or um, or do you think that's a factor or not?
I have to think about that.
Because that's a very big difference between China and a lot of, now granted their population is going to start slowly shrinking here in a little bit, but they're still huge, right? So um, if AI and robotic manufacturing really takes over and there's less of a demand for um, unskilled workers, what do you do with the unskilled workers, right? I mean, definitely you want to get them skilled, kind of like how we went through the agricultural revolution and the industrial revolution, right? When those shifted over. Um, so yeah, what they were talking about earlier was what they were talking about earlier, I think in the comments, was about education being free in other areas and things like that. I mean, that almost sounds like something that would almost be a necessity, kind of like what we did with high school back when we switched from agricultural to industrial. What do you think?
Um, yeah, I know that's going to be a problem like sooner than you think for like truck drivers, like Elon Musk is talking about as, automated trucks. Well, there's quite a few truck drivers out there that are going to lose their job over the next X years.
Yeah, I think that's the number one. Isn't that the number one job in the United States?
Truck driver?
Yeah.
I'm not sure. There's over 1 million of them. There's a lot. But yeah, it's going to have a big effect because what do those people do after their job is replaced by a automated truck?
Yeah. Um,
Yeah, and it's not just trucking, a lot of other jobs. Well, I even eliminated a few jobs in the Air Force when we went to a dispatch system. The Air Force in Europe used to have dispatchers at all the base operations at every base, and we centralized that kind of like the airlines. And we set up a shop at the headquarters where I was, and it was painful for people to. There was a lot of pushback because people have their empire. Now you're trying to get rid of some of it and make them less important by getting rid of some of their people. But once the general saw what we were doing, he's like, okay, yeah, this is a good thing. Let's keep going. But there's definitely a lot of pushback to technology. Um, but yeah, I mean, all these people have jobs and houses and everything. What do they do?
well, and then yeah, and then on top of that, the major way to wealth over the last generation, um, from the 80s and forward, or I guess maybe from the 70s and forward, as interest rates were at their highest, was we had this big real estate boom in the United States, right? So there's one wealth avenue that's going to have some serious headwinds in the future, is real estate. And then especially if we actually do somehow figure out some way to let interest rates rise, if the Fed ends up actually doing that to stave off inflation, and in order to keep the stability of the US dollar as the world reserve currency, they're going to have to stick it to someone, right? Either the government goes bankrupt and we raise interest rates to stall out inflation in the United States or in the dollar, um, or we don't raise inflation or we don't raise interest rates, but and then inflation takes care of the housing prices, but it's not, you know, it's not the same as what happened in the 80s going forward, when we just had severely dropping interest rates that were just pumping up home prices well beyond their value because debt for that product was so cheap for so long. So there's one avenue of wealth that the general population in the United States is not going to have, or will have a harder time doing. And then now it's going to act more like a savings account that has that you have to maintain. And then if they do tax businesses more and LLCs specifically, right? That was a major way of American citizens making it to more wealth, right? Was business ownership through LLCs and sole proprietors and things like that. Well, if they tax the crap out of them, that's going to make their growth harder and the barrier of entry even more. So you're starting to shut off all these doors to take from a middle class American to an upper middle class or even a wealthy American. So it's kind of like, if the goal is to stifle, class movement within a population, I think, we're definitely on a good track to stop that. So,
Well, I think the business tax they're talking about is a corporate tax. So LLCs and sole proprietorships and everything, where the income flows down to your personal income, as long as you're below their $400,000 threshold, I don't think you'll really see much of an impact. So I think the
oh, that'll be
smaller
good.
businesses, like a little restaurant or a hair salon or something, unless they're making a lot of money, I don't think it'll impact them too much.
Oh, that'll be good. I mean, it'll be nice to see how Biden says he's going to unleash the uh, tax bill and how it's going to look at and how they're going to generate the revenues that they've been looking for and things like that. So,
Well, I mean,
uh,
certainly there are inequalities. Like Warren Buffett said he paid less tax than his secretary did. Y- You know, I read Elon Musk doesn't take a salary, or maybe it's like $1 a year, and he just pay if he needs money, he just sells stock
yeah, you just do a
or,
stockholders loan.
or he does a loan. Yeah,
Yeah.
so there's ways around generating income. Even President Trump, how many years did he pay? Like $750 in tax.
hmm Yeah. I
So,
mean,
I mean, part of raising taxes is more tax equality, I guess, but.
right.
Yeah, the wealthy write the tax code. I had a class on taxation in college, and it was funny. It's like a cat and mouse game. The IRS will see somebody abusing a tax thing, and they'll change the tax code to cover that, and then they'll find another loophole, and then it's like whack-a-mole. There here's a loophole. Oh, now they're using it. Oh, we got to stop that one. Then they'll find another one pop up here. It was like this constant evolution.
Yeah, I mean, now I guess, what this all, kind of comes down to is, what does it look like for investing? I mean, what does it look like for even trading and things like that? I don't know. I mean, where do you see that here, Tom? Does any of this apply to, growing wealth
Well, I mean,
through
investors
investing?
are looking at where can I get yield?
hmm
Um, can I put my money in bonds? Well, what are bonds yielding? Almost nothing. It's less than inflation probably. So that's almost like putting it in your mattress. So people have to put their money somewhere.
Right. And holding it in cash or working for time is going to be definitely one of the worst things you can do. Um, Yeah, I mean, it's one of those things. I mean, especially like so right now we're in the middle of a correction, right? Definitely in a small cap correction. We're here talking about raising taxes on businesses, right? And I really and maybe I got to look up this Biden tax bill tax on. I thought he was closing some of the issues or yeah, so could increase the corporate tax rate to 21 to 28. 25 might be more attainable. And then let's see. Yeah, it's going to be really interesting. I mean, because that's all contractionary, right? That's all going to slow the economy, right? It's completely opposite of like Reaganomics and things like that. So um, it'll we could tariff, right? But then of course, by tariffing, really what you're doing is you're actually taxing consumers, right? Because it just increases prices to the consumer. So either way you look at it in history, right, the longer the taxes go on, or the longer a civilization is around, the more the middle class pays in taxes, which is why the middle class eventually get whittled down to the lower class and the upper class. Um, and then there's a revolution, right? That's
And then, well, you have like hyperinflation mixed in there too with fiat currencies. And I
right.
think I think we've long passed the point of being able to actually pay off the national debt. So how does it unfold where the fiat currency falls apart?
Well, I mean, what's interesting there, I mean, this would be a really sad situation, is that we do let the or we do let the currency float, but the currency is technically backed by American assets and the GDP, right? So we could sell assets, right? And Trump reserved a boatload of oil when it was really cheap. We've got a bunch of gold in Fort Knox. I think we have, more gold than I think like the next three countries combined. So, I mean, we have a boatload of assets that we can sell to bring down the debt. That would just be really sad, though. That is that's a poor person's way to pay off debt is to sell things. That's like going to the pawn shop, right? You don't want
Right.
to sell assets. You want to accumulate assets. So, yeah, really, really interesting situation there. But I mean, going back to this correction that we're dealing with right now, small caps are being brought down. They've been overbought for a while, things like that. And the reality in the scheme of things, if I were to, parachute in right now and just kind of see what the backdrop is interest rates are being held artificially low. There's very low yield out there. The 20 year is close to inflation. The 10 years below inflation targets. We're looking at more inflation on the horizon. So if there's more inflation on the horizon, you got to invest in places that are going to be relatively inflation protected, and that there's at least some decent expected return over those inflation targets, which right now that's still stocks. Um, that's stocks, right? And if I shouldn't say if, but when inflation in the U.S. dollars does start to rise, it looks like on these projections, which I'm not even sharing my screen anymore, but that's okay. Um, by the late half of 2021, right, inflation will have started picking up again, and we'll probably start to see some emerging markets do pretty well by that point. Right now, they're facing some serious headwinds. So, small caps and emerging markets are facing headwinds right now, which is why, of course, like the service that I run, which is the Sleep Well portfolio, has had a correction. If it's happened before, it'll happen again. I actually put a post out on the forums. I don't know if anyone ever saw it, but I just grabbed a picture of the drawdowns of the Sleep Well portfolio, and I just said, hey, it's always a good time to jump into a trading strategy if it's kind of drawn down. If you were thinking about kind of getting into something, so it's we get a correction of this size in the Sleep Well portfolio about once a year. It's a little bit less than that, but over the last like 13 years, I think we've had 9 of these opportunities. So, was the largest drawdown on the Sleep Well?
Wasn't it just over 10%?
It was, if you weren't doing slippage and you were right on time, basically like Tuesday morning, right when I do my allocations, it's about just over 10%, 10.4. If now that's historically, of course, any good investor or trader knows that that can be breached, right? Just because we haven't breached anything in history. So prior to 1929, we never saw a stock market crash, but so I'm not saying that it's poised to do that, but I would always buffer a couple percents if you're trying to look at behaviorally, what can I handle. But we get about a 6% drawdown, which is close to what we were at, and we're probably close to that today. I haven't looked yet. But a 6% drawdown, we get that about once a year. And that's about it. We do get a little bit deeper than that. I think there's been 3 corrections that have been close to that 10%.
I think right now you're at 4.25% drawdown.
Oh, okay. So yeah, not nearly as bad as I'll have to look at that again. Because yeah, we were on Friday. When I posted the picture on the forum on Friday, I think we were like 5.9. So there was a pretty large drawdown in Russell's. I think it might have been Thursday that I posted that. It was the low. I was looking at it at the day. I saw the capitulation. I was like, oh man, we're gonna bounce. So I just kind of threw it up on the forums is like, hey, look, what's the historical annual return? With the new data, everything in, it's about like 10.6. So average. Yeah,
Yeah,
thanks.
it's pretty nice returns with the smaller drawdowns are very attractive, especially to older people that are trying to protect their investments.
Yeah, Tom, if you've got that link, can you throw that in there if you wanted to look at it? But
Which link?
just to the more info tab. Let's see, I can throw it into.
Oh, well, the information page, if you
Oh yeah,
scroll down a little bit, has, I just updated it. It's got the current trade performance.
yeah, and you can see that this rotation has definitely been a headwind to the sleep well, and this is it's a macro investing approach. So it's not, we're doing market timings and things like that. It's not an algorithm or something like that as far as what this is considered. It's really just saying, hey, in these macro events, we've got rising inflation, or maybe we've got deflation and things like that. Where is the least risk in the portfolio, and that's least risk for the potential. So kind of expected returns looking forward, and that's how it divvies up its allocations, and it mutates, or it self adapts moving forward. So as the models shift, it shifts its allocations. Sometimes we have an allocation to all of them, all of the assets in it, but it's meant to be very simple too. I took a very complex concept and things that I worked with wealthy individuals, and made it extremely easy and simple to manage, actually, to the point where now that's what I do with some of my IRAs that I don't really want to pay attention to, and I just check on them once a week and reallocate, and boom. So what type of cash products are assets parked in during transition periods? How large does cash percentage? Oh, yeah, this is always a fun topic. So cash. So I use UUP, which is an ETF. So all the assets we use are ETFs. So that's a really efficient way to get diversification and keep its simplicity. So I use UUP to get cash allocations. So instead of investing in cash directly, we use UUP during deflationary time periods against other currencies, so that we have a potential to actually gain on dollars for holding dollars. There are some subscribers that, for some reason or another, aren't able to go into UUP. Uh, they use a different asset, or they just go into cash. And so as the allocation in UUP increases, they just go into cash. So anyways, but these transitions, as they go through macros, we pretty much just hold on to them, and we let the portfolio slowly shift through these transitions. One of the biggest questions, or one of the most common questions we get, is there's always a lot of fear, and rightfully so. It's never pleasant to lose money in the short term, but there's a lot of fear around corrections, and large corrections specifically. The way that the portfolio typically works is large corrections that are going to be something substantial, and they're not just transitory, normally are backed with a pretty large fundamental shift in a macro sense. So something like COVID, for instance, right? Prior to COVID, there was a lot of red flags. I apologize for not being on Aramir earlier. Prior to COVID, I would have talked about this more. But anyways, prior to that, there was a lot of issues. And so there was a lot of red flags. So as soon as stocks started selling off as hard as they did, it was very clear to not be in stocks. And in fact, I'm working with Tom here to get kind of a macro indicator, I should say, maybe something like that. But it's like a macro sector indicator that if people are interested in, or definitely email Tom, because we just got to know if it's worthwhile to kind of put it all together. But if the macro situation states like what sector of the S&P is most poised for return, historically during those macro environments. Of course, going forward, that can change and things like that. But something that's always really fun is an out of data sample test of COVID. Actually, I think like the very first week of the sell off in COVID actually would have said that all sectors in the S&P had negative expectancy on a macro lens. So that's kind of that's kind of the power of macro, is that it can really say, hey, our stock's really susceptible, or is economic growth really susceptible to correcting very large? And right now, we don't have that. Now, can it shift, or can we get caught on, on the wrong foot sometimes? Absolutely. We're definitely being caught on the wrong foot with the Russell right now. So, do you consider tax consequences when you pick ETFs? No. I originally designed this for I originally designed the Sleep Well portfolio for retirement accounts that are untaxed. There are quite a bit of people actually that do use it in tax. They leverage it typically. And then if there are some that are skilled enough, or at least have the knowledge to run options on the indexes, which gives them the 1256 contracts, so the 60/40 tax benefits. So there are ways to reduce your tax load on them, though.
Yeah,
Anyways,
me, I was gonna say too, one of the things on my to-do list is to do a comparison chart of the sleep well to the RPAR.
yeah, thanks for bringing, yeah. Tom, how is that actually coming?
Well, slowly. Gabby was in the hospital last week, so I lost a day or two with all, anytime you
She's
go to
doing
the
okay?
ER, it's 3 hours plus. Well, she had a pretty bad cough and fever and everything, and it turns out it was pneumonia, but they first thought it was COVID, so they were
Mm,
treating her like a hot potato. Everybody's dressed up in their,
right.
yeah. So but yeah, she we're like four people came into the ER room we were in, and COVID. Is like, well, how do you know it's COVID? You never did a test. Oh, really? So they did a test and it was negative. It was just a bacterial infection. So she's on some pretty heavy antibiotics right now, but I got a little bit behind the power curve with all dealing with all this, but
Man,
but she's doing better. But
that's
yeah,
good. That's good. She's improving. Do
yeah,
they have her?
we actually went on a walk yesterday, which was a lot of effort for her, but definitely it was good to do, get her out in some fresh air.
That's really good. I'm glad she's up and around, and I'm sorry to hear that. So, um, I wish her well.
Yeah, well, like I said, it was the bacterial, and antibiotics fortunately were coming to the rescue. One thing I hadn't considered, that with this strong antibiotic, it also the pharmacists at Walgreens said, oh yeah, it's also killing the good bacteria in the intestine. So take a lot of probiotics. And
Mm,
the first day she took this really strong antibiotic, and nausea, vomiting, diarrhea, all that kind of stuff. And then after she started on the heavy probiotics, then now it's not a problem. So
mm.
that was a good call from the pharmacist.
Sweet, sweet. I'm glad she's doing better then. Yeah, keep me updated on that for sure.
Yeah,
Um,
but yeah, as far as the sleep well versus the RPAR, that's coming.
okay. Yeah, I mean, I pulled up a graph of it. Like, I always pay attention to RPAR. So for anyone that's not familiar with RPAR, it's risk parity. It's kind of like the quote unquote all weather, or kind of what Ray Dalio kind of coined. Um, so um, as far as how they've done, like since the sleep well came out at Aramir, they're up like 3.5%. Tom, what's the sleep well at right now?
Mm, let me look.
Uh,
27.73.
okay. So here I'll just now let's see. Yeah, you can see that we've had some headwinds lately and everything like that. But yeah, 27.73. So that just kind of gives, I mean, just use some macros in your allocations, right? There's some things, this headwind has mainly been from bonds. A 60/40 portfolio has actually fared better than this, but still those bonds have been really, really eating away at it. Because if we look at bonds on their own, so if we look at bonds on their own, I mean, that just kind of tells you right there, don't have bonds, right? It's not
Right.
a, it has not been a good play. Now, short term, this is actually, this kind of almost got to an equilibrium, especially with the dollar kind of gaining some strength and stuff like that. So you got to watch out with this. This is probably kind of poised to have a little bit of a bounce, but um, it'll probably continue its free fall here in a little while.
Well, it's interesting. Bonds since this 29 September is when you guys started the sleep well. And if you, that's right where it started going below zero. And your allocation, I don't think I've ever seen it with any bonds.
No, like the week before we started, we had like 2% bonds, I think.
Okay.
So it was really close. I think this is about where we started. No, it's a little bit more. So like 135. Oh no. Yeah, that's probably about, yeah, we
It was the
started on the
29th of
29th.
September. Yep.
So um not 13 days. But anyways, yeah, it's been one of those things that i- if you study stimulus and things like that, bonds are a fantastic thing to have before the economic and the growth contraction happens, which is why we get like pre warnings when you look at sleep well portfolios, or when you look at the sleep well portfolio, we get these pre warnings because we're not the only investor out there in the world, and a lot of money is done in institutions, and they're much smarter than I am. And those institutions push money into bonds prior to the correction, or if it's going to be an inflationary correction, they'll push it into gold, right? So we had an inflationary correction, and we had a deep enough correction that bonds were poised to correct. And so here we go, right? Pre-COVID, all of the warning signs were there to to get out of Dodge, right? This, if we do correct, it's not saying, hey, everything's going down just because we have some alternatives going on. Actually, we can have alternatives going on and stocks doing really well at the same time. But the probability of a correction being a more meaningful one when those are outperforming stocks, that's when you start to have a little bit of a red flag.
Oh, it's an interesting question about Sharpe ratio. I've always used Sortino ratio, which is the return compared to the risk it's taking. But the Sharpe ratio is comparing return to the risk-free return. And I saw a thing on, I think, one of the Investopi or something, that Sortino ratio is more appropriate for higher risk investments and Sharpe ratio for lower risk. So I'll probably replace that Sortino ratio with a Sharpe ratio. That's
you,
actually a good question.
you can probably put both in there. So like I use Sortino, of course, but the reason that I use Sortino is because it looks at the return to the it only,
Downside risk.
right, it only takes downside deviation for risk instead of upside. So I mean, it depends on what type of investor are you, right? If you just want the lowest deviations, right, then something like risk parity actually might be a better type of situation, because risk parity, or RPAR, is going to have significantly less daily standard deviation because it uses many assets balanced all the time, whereas the sleep well kind of picks and chooses them and adjusts them based on a macro lens for the return to risk orientation. So if there's better return in certain assets, even though there might be more volatility in it, the sleep well will actually prefer that because it's looking at the potentiality for its risk. Whereas if you just look at, and it's really flawed in finance, right? If you just say that risk is how far something deviates from its mean, um, that's something that like Sharpe ratio takes into consideration, and then it doesn't take into consideration correlation factors on fractal timeframes, right? So that's where RPAR runs into a problem. And there are funds that do a lot better job than just the all weather portfolio. But the reason why this has been having such an issue here, right, I mean, even back in June of last year for all this run up, I mean, it's still only up 11%, which actually is fantastic. I actually, maybe I won't dog on that. Like, hey, 11%, that's awesome for just like a set it and forget it, let it rip type of thing. But the reason why this has been so correcting and it hasn't been able to return as much as like the sleep well portfolio is because bonds, gold, they've been correlated, or they correlate over a longer time frame, even though their correlation on a daily sense is a certain amount of correlation, and their volatility on a daily sense is a certain amount of correlation. Their volatility over a certain time frame, or their ability to trend together, has a significant risk factor in it, and that's what the sleep well portfolio attempts to take out, is their trend risk factors, right? So anyways, what is the Sharpe ratio? Actually, yeah, I don't know. I'd have to calculate that. I've got the Sortino ratio, so I can get back to you on that, Andre.
Yeah, I'll figure out what the calculations are and add it to that list. So not a
Sure.
problem. All right, well, we're a little over an hour, but really good discussion. Thanks everyone for participating. Lots of good comments in the chat, and lots of interesting charts. I've taken some screenshots of the URLs, and I'll add those to the meeting link so you guys can all get those. And yeah, we need to wrap it up. I've got another meeting coming up in about 20 some minutes. I don't think we have any roundtables this week. Let me just check. Let me just look. What do we have? Oh yeah, it's next week. Marco from Option Slam will be presenting his double eagle next week. And then Wayne, you're up the week after with the Sleepwell portfolio update. So that'll be good. So thanks everyone, really appreciate it. I'll get this recording posted as soon as I can, and have a great trading week, and we will see you all next time. Thanks a lot.